And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. It is, of course, the second best day of the week. It's also 2 days before the conference coming up this Saturday. Michael Leibowitz joining me today. Of course, he'll be there on Saturday to do his presentation on everything about bonds, interest rates, inflation, etc. So again, if you haven't got your tickets yet, go to the website. We've got just a few left, and they're on the website now, realinvestmentadvice.com. Just click the blue bar at the top. And again, we'll see you on Saturday. It's going to be a lot of fun. A few things to get into today. Obviously, Mike and I will spend a good bit of time today talking about yesterday's CPI report, what it means for the bond market. Does anything change? Does it matter? We'll get into all of that this morning. Of course, yesterday was that CPI report, and as we noted yesterday, that was going to determine the direction of the market. Everything had been really set up, kind of primed for that report, so we got that out. Now, with that report behind us, we're still not out of the woods yet in terms of inflation reports. And because the next reports coming up are going to be GDP. And after we get the GDP report, we're going to get the personal consumption's expenditures report. So that's going to be, of course, the PCE report and and particularly the trimmed mean PCE. That is the number that the Fed looks at the closest. That's what they really focus on. While the market focuses on CPI, it's really PCE that the Fed focuses on, and that's going to be really the big report coming up next week, and we'll take a look at that. Also, we're right at the beginning of earnings season. Yesterday, we had reports out from JPMorgan and Goldman Sachs, both just killing it in terms of revenue. Net interest income for JPMorgan was increased. Of course, not surprising, with higher interest rates, you make more interest income. So that really certainly helped the bottom line for JPMorgan. Particularly since they collect higher interest and then they don't pay you any interest on your money market accounts. They really get to keep that spread. So yeah, net interest income doing well for JPMorgan. More bank stocks today, regionals as well, and we're going to see a lot of regional banks now between today, tomorrow, and early next week as all the regional banks reporting. So again, what we're looking for there in particular is kind of a look back at the Silicon Valley Bank crisis. The last time we were having sharply rising interest rates, the Silicon Valley Bank crisis, of course, occurred. The Fed had to step in, do the bank term funding program to help bail out those banks and stabilize collateral values. Well, interest rates have been going up. That's certainly been putting pressure on collateral values for these regional banks. So we'll see what they say. We'll see if they're doing okay or not. And so those reports are coming up over the next few days. That's certainly going to potentially either boost or weigh on the financial markets. The big banks are different. They have so much more access to markets, capital markets, and investing, trading revenues, all these type of things. It's a different story for the JPMorgans, the Bank of America, the Goldman Sachs of the world. These regional banks are pretty much tied to making commercial loans. That's the big chunk of their revenue, is making loans to small businesses and residents and auto loans, those type of things. So interest rates, higher interest rates, certainly demand from borrowers, certainly going to be kind of the key that we want to be looking at. Because they'll tell us two things. One, the health of the banks, right, those regional banks, but also really the health of the economy. So we're really going to get two stories coming out of the regional bank reports over the next few days. The week after next, we're going to start getting into all the big mega cap stocks, right? So we'll start getting Apple and Microsoft and those guys as well. It is expected right now that we will have in excess of $1 trillion this year in stock buybacks, based on announcements. That'll be the first time we exceed $1 trillion in a year on buybacks. Think about that for a moment. That's $1 trillion in 1 year in buybacks. So that's certainly going to help boost asset markets as well. Obviously, that's $1 trillion buyer for stocks in the markets, of course, mostly large cap stocks. So again, I would expect another year where large caps continue to outperform small and mid caps. Lots of expectation and hopes that somehow, miraculously, small and mid cap stocks can come roaring back with earnings growth. Not sure where that's going to come from, but large cap stocks certainly will benefit from $1 trillion. That's just kind of mind boggling. Just kind of imagine how much $1 trillion is. I know we throw around trillions and billions now like left pocket change, but it's a lot of money. be spending on stock buybacks. Could be building plants and putting people to work and, paying higher wages. Now let's just do stock buybacks. Better for the stock market. All right, let's talk a little bit about what you need to know before the bell this morning. So yesterday we had talked about, in particular, that with the PPI and the CPI report coming out, that was really what the market was hinging on. We had spent Monday and Tuesday literally clinging by our fingernails to that 100-day moving average, and we had broken below it, got back above it at the close, broke below it the next morning, climbed back above it by the end of the afternoon. The markets were anticipating the report that we got. We'd had a bunch of sell-off in the markets, of course, reversing some of that previous overbought extended condition, had worked off a lot of the markets into a more deeply oversold condition. Sentiment had gotten fairly neutral, not negative, but kind of neutral, but really from being overly bullish to neutral. So we had a very good setup, and the market was starting to kind of sense over the last really 2 days heading into the reports that they would likely be basically benign, which they were. And so, of course, that report yesterday led to a as we said an inline or better report. Look for a fairly sharp jump in the markets. Exactly what occurred. We got above the 20-day moving average. This morning, we are wrestling with two key areas for the markets right now. First of all, the market is right up here against the 50-day moving average. So that's going to be a key break. If we can get above the 50-day and hold that through the day, that's going to potentially set the markets up to rally a little bit more into Friday, potentially reverse this. We're very close to triggering back onto a MACD buy signal. That should give the market some additional lift up towards 6,000. We'll kind of see how this plays out over the next few days. But the other side of this also is that we have a very defined trend line along these tops here that the market's going to wrestle with, and it intersects right with the 50-day moving average. So you have these two key levels of resistance this morning. If the markets can break above that, we'll likely get a little bit of follow through here over the next few days, kind of heading into the inauguration. Now, understand that Monday is a holiday. It is Martin Luther King Day on Monday. So markets are going to be closed. So again, we'll have a holiday shortened trading week next week as well. We also have the inauguration next week. So very likely we're going to see a bit of a push higher here, just considering the fact that we're not overbought. Sentiment is fairly negative, so that gives us a good bit of fuel, so to speak, with this kind of overbought buy signal about to turn up. More importantly, we're starting to see money flows turn positive. Yesterday, we had fairly negative money flows during this entire decline, which exacerbated the decline a bit, of course. But over the last 3 days, we've seen those turn, and yesterday money flows actually went positive. So we did see some fairly decent buying power coming into the market, and there's likely a good bit more of that sitting there right now, looking to at least for a tradable rally here, if nothing else, push asset prices higher. Again, as we've talked about before, we're certainly not out of the woods. Lots of expectations for an increase in volatility this year. We're not out of the woods yet, of course, on the concerns about inflation returns, what the Fed's going to do. So again, on this rally, use this rally to rebalance risk a bit. Trim exposure if you need to. Things that haven't been performing, let those go. Buy stuff that is performing better. Just your normal processes of managing money. But use this rally to do it. Don't expect this rally to just take off and run off to a new bull market high. It could, but there's a lot of reasons this year that we're being a little bit more tactically bearish, as we talked about on Tuesday. And if you haven't read that article yet, we certainly encourage you to do it. There's some reasons to be a little bit more concerned about what the outlook's going to look like this year for the markets. Just very quickly, of course, the big news yesterday was this very, very sharp drop in bond yields that occurred. Again, that, we've talked about a couple things, and things I'm going to address with Mike this morning. As we said yesterday, term premium is complete hogwash. It's just a plug number for what I can't explain. But we had market yields running up in anticipation of this inflation report, a very, very sharp drop in yields as core inflation actually declined yesterday. And that really kind of brought up the potential for rate cuts to about 38 basis points this year. So already markets are starting to price in more Fed rate cuts. That was bullish for bonds yesterday, very close to triggering a buy signal on bonds from these levels. So again, just a couple of things. We're going to get into more of that with Michael Leibowitz, but that's what you need to know before the bell this morning. And when we come back, we'll pick up with Michael Leibowitz. We'll talk about the report yesterday, any insights to that, inflation, other stuff, all coming up next on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, it is Thursday, and the day after the inflation report. Got past it, right? I mean, everybody was just on kind of pins and needles waiting for that inflation report yesterday, not knowing what was going to happen. On Wednesday, Mike and I made some change, and Nick, of course, in our portfolio management team, we made some changes to our portfolios just kind of in anticipation of that report, and we kind of increased a little bit of exposure to some beaten down stocks. Yesterday, we added Palantir to our portfolio as well, which has been down about 20%. We added some added to our AMD position that have been beaten up recently. We also trimmed some stuff. For example, we had added some energy stocks a couple of months ago when energy prices were really kind of beaten up and oversold. We had added those to our portfolio. We trimmed those out yesterday. We also had reduced JPMorgan just in case, higher interest rates had impaired them. Again, we're still long the position, but we just kind of took some profits, rebalanced the targets. And, these are the things that we talk about a lot. And, I've talked a lot before about, kind of investing rules and strategies. And one article that I publish kind of every year or so is one about how gardening applies to your portfolio. That comes out tomorrow. So if you haven't read that article, it'll be out tomorrow. But it's how to look at your portfolio like a garden and use the same rules of gardening if you're a gardener. Use kind of the same rules of gardening that you do in your portfolio, and you'll do better over time. But those were the processes that we were kind of working on because we had no idea how that report would come out or how the market would react to it. And because, lately we've seen some reports come out and markets are just kind of digging for any little nuance to try to fit a narrative. And, it was interesting with the PPI report, the Producer Price Index report on Tuesday is a good example of this. The report was fairly weak across the board, but there was one aspect in there, which was air transportation that had a really sharp spike. And this is a super spiky index. This particular model or input is super spiky. It's up huge one month. It's down huge the next month. It's up huge the next month. There's no trend or issue to it that is supportive of a narrative of inflation moving. But everybody focused on that on Tuesday, that one little input. And that was kind of the worry going into Wednesday is that the broader index could be down or flat or in line, but there'd be one little aspect that everybody kind of focused on in the market. So that was the reason for kind of taking a little bit of risk off the table. We reduced our overall allocations by about a little over 1.5%. But that was the reason for doing it. So now we've gotten past that report. We can start talking about some other things and start thinking about what to do next. But Mike, speaking, to the CPI report yesterday, was there, outside of the headlines, anything that, you were looking at in particular?
That was super spiky. I like that term. No, it was slightly better than expected. And I say that because the monthly headline number, so the headline number includes everything, food, energy, it's the whole kit and caboodle, met expectations. It was high at 0.4, but that's what the market was expecting. But the core number was 0.1% below expectations. And I think that's what kind of fueled everything. Mm-hmm. And it's not that it was 0.1 below or, even when it's 0.1 above. The inflation, we've said it a million times, it's impossible to calculate for so many different reasons. And, even if you trust that the BLS is using the right prices and the right allocations to every type of good, it's still impossible. And there's variation from what's going on in the real world to their numbers. So the fact that the market trades so intently on 0.1% in a number that will probably be revised, once, twice, 3 times over the next few years is crazy. But that's the crazy that we have to deal with every day. And I think what the market really liked about that number is that it wasn't showing a resurgence of inflation. I think we can all agree that inflation is somewhat sticky here. We're kind of grounding out above the Fed's target, not at a historically high rate, but at in a mid to 2.5% to 3% range, depending on which indicator you like to use. Mm-hmm. And the Fed has made note of that inflation is still sticky at high levels. But again, Lance, the CPI report is so flawed because of that shelter reading. Right. We know for a fact that shelter prices, if they were calculated using the way they calculate everything else, that CPI would be below 2%. CPI less shelter is 1.9%. So CPI for every other good is 1.9%. Core CPI less shelter, they call that super core. It's like super spiky, right. Super core is 2.1%. Mm-hmm. So there is inflation. There's inflation. It's 2% inflation, give or take a little. But shelter costs are just having a big effect on it. And then every month there's something. You mentioned airline fares. Mm-hmm. Well, airline fares they're whipping around all the time.
They're super spiky.
Super spiky. And during the there's your title for this one, Brent. Exactly. Super spikiness. During the holiday seasons, they become super spikier. Right, because there's more demand and the airlines have more ability to raise their prices. Right. And, the BLS will use seasonal factors to try to adjust for that, but they're poor. And year to year, they don't carry over. There's always something different about this year than the prior few years. Right. So, inflation is pretty close to target. And, we can quibble whether it's slightly below 2% or the mid 2s or maybe even 3. But there are no signs that inflation is getting ready to take off like a rocket ship again.
Well, and there's also, you're bringing up a key point. So first of all, just real quick, a couple of notes here for context. When the Fed's talking about 2% inflation, that's a round down number, right? So if you take a look at what they estimate, it's a 0.2% monthly increase in inflation, which is 2.4% annually. So 2.4 rounded down, you get 2%. So that's where their 2% target comes from, which is this 2.4% rate that is average. And that's basically been the average going back to the turn of the century. Boy, that makes you sound old. But so one thing is that we're actually fairly close to the average rate. More importantly, inflation doesn't stick at a level. And if you go back and just, and Mike, you know this because you've done so much work on CPI and everything else. You take a look at at the CPI index going back over time on a year-over-year rate of change. It's super spiky. But no, it's up for a few months, then it drops sharply, and then it rises again, then it drops sharply. And the average is this 2.4% over time, but it trades constantly above and below that level because the economy's changing all the time. You have economic, expansions because of wildfires and hurricanes that create short-term anomalies in the markets that create a boost in demand relative to supply. And you have periods where the economy slows down. People, start kind of contracting, spending a bit. And there's kind of an interesting thing going on right now, which is, and there's this trend that's starting across the internet, which is not to buy anything and just to only buy necessities and barter for everything else. Well, if that catches on, and all of a sudden everybody says, okay, we're not going to go buy anything except just the raw necessities, inflation's going to fall because demand's going to drop and economic growth is going to slow down. So inflation is driven by consumption at the end of the day. And so changes to consumer demand and consumer, really kind of consumer incomes mean a lot to the outcome of what happens with inflationary pressures and economic growth over time. And none of those trends right now, you take a look at the employment numbers, a good example. Employment is dropping rather sharply. Yes, we had a strong employment report, but the 3-month trend of employment is dropping sharply. Wages are declining. All those suggest that the consumer is going to slow down over the next 12 months, which is going to lead to a lower rate of inflation.
Full-time jobs are declining.
Exactly.
Part-time jobs are increasing. Lance, going back, though, can you send me a link to that not spending thing? I think the Leibowitz GDP could really use that if I give that to my wife.
Well, you were talking about having to deal with, this is the crazy we deal with every day. I thought that was my wife. So, but yes, I will send you the link of the no buying move. That's the new thing.
Maybe if the delivery guy with a package just didn't come one day out of the 7 days, that would be an improvement.
That this is the big risk to the economy is that if this no spending movement takes place, is that we're going to have massive unemployment in delivery drivers. This is going to be the problem.
Right. It's nonstop. When I'm working from home, my window faces the front. Nonstop, there are delivery trucks, not necessarily coming to my house, but going up and down the street. And then all the cars and, that are delivery cars.
No, it's bad when my wife gives a Christmas card to the Amazon driver. So, I mean, we're at like first name basis. So anyway, So this is kind of crucially important, and the trends that we're looking for. Again, there's lots of expectations in the markets about things. Markets are driven by sentiment and expectations. Fundamentals are what matter over the long term, but in the short term, it's all about fundamentals. It's all about it's all about sentiment. Same thing with yields. As we were talking about yesterday a bit, this whole idea of term premium is just a plug for something that just you can't actually factor. So it's just, we come up with these fits. But sentiment drives markets, all markets short term. Long term, it's all fundamentals. And that's why we focus so much on the economics when we're talking about long-term outcomes. All right, when we come back from the break a little bit, I'm going to let Mike give you a little bit of a preview of some of the stuff he's going to be talking about this weekend. So if you haven't got your tickets for the upcoming event this Saturday, get by the website, realinvestmentadvice.com.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today. Register today.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I loved having everybody at home. It was great. Kids were all here. Daughters brought boyfriends, etc. Big full house of people. I was so thrilled when they all left.
The Real Investment Show podcast.
My wife said after they left, she's like, yes, alone again.
Same show, your schedule.
I was actually talking to my daughter. I said, I'm going to put a sign on your bedroom door that says McKinsey's B&B.
At realinvestmentadvice.com.
Because she shows up, she gets fed free breakfast, free lunch, free dinner, and then somebody magically makes her room before she leaves, right? So,
why would you leave?
I know, right?
Sounds pretty good to me.
Yeah.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Hey, do us a favor if you're watching the show right now on YouTube. We certainly appreciate you. Smash that like button for us real quick. It does help a lot. You really don't understand how much it does help us, and it helps us a lot in growing the channel and making it work with the YouTube algorithm. So if you don't mind just reaching up there and clicking that little thumbs up button, we certainly would appreciate it very much. Real quick, Mike, I wanted to give you just a second to kind of just give us a little, kind of a quick preview of some of the stuff you're going to talk about this week. And don't give away any of the sauce, right? Got to, as my wife says, you got to keep the tea for the weekend, right? For Saturday. But before we get there, don't give it away just yet. Hold on. I was reading a headline, Brent, just a second ago about the cost of rebuilding homes in California could top $250 billion. Now, and this is something I was it just kind of crossed my mind because, if you live here in Houston, we've been through several floods, and we had during Hurricane Harvey back in 2017, we had some massive flooding, what they call 500-year floods. And we had some flooding in areas that were never supposed to flood, but they absolutely just flooded, devastated homes. And there was shortly after that, a rule change. Insurers basically changed the rules and said, it's fine if you want to build a house in that floodplain, but you can't get flood insurance. And so I'm curious if insurers after this start to come back in California and say, if you want to build a house in California, it's okay, but you can't get fire coverage for it.
Well, they're already changing the rules.
Yeah. Well, that's part of the article I saw. Yeah. But yeah, the insurers are starting to change the rules. But it'll be interesting, say, if because again, this is what they did in Houston. I think it's and don't quote me because I don't live in Florida, but I think it's also the same issue in Florida. There's areas you can't get flood insurance on your house if you build in certain areas, like the swamp. And I think there's some crocodile insurance in there you can't get either. But it'll be interesting. All of a sudden, all these people that want to build these multi-million-dollar, mansions and stuff in California is great, but you can't get fire insurance for it.
Well, all of us are dealing with higher insurance rates because of the losses that the insurance companies have had to pay out over the last several years.
Right.
And it's hitting everybody regardless of where you live.
No, it's true. No, absolutely true. I mean, this is one of the issues that, Mike has talked about a few times, just looking at the CPI. We've seen insurance go up, not just healthcare, but just insurance in general, car insurance, everything else has gone up. Anyway, Mike, any comments on that?
Yeah. So we had Hurricane Sandy a while back, but after that, a lot of jurisdictions along the coast said, if you're going to build, you have to put it up on stilts, up elevated. So I think in California, I've seen some instances where there's one house on a block, everything else is burned down, and that house used some cement or things like hardy plank or, non-wood type products. And I think they're going to change the code too, that if you want insurance, you better build it a certain way that can withstand, at least some fire.
Yeah, if you build out a cinder block and, just
you
a brick house.
You put stucco over cinder block.
Yeah.
I mean, you do what you have to do. This area is prone to fires. You got to build for it.
No, that's right. I mean, it's same thing with, earthquakes and building,
they do
building
that.
buildings with earthquakes. Yeah.
Right. I mean, that's what's going to happen. It's going to be more expensive to build the houses, but they're not going to burn down so quickly, in theory.
Absolutely.
So regarding the conference,
yes, there we go.
I need to give a big shout out to Michelle Ratliff, Danny's wife, because she asked me a few weeks ago if I needed anything. And I said, no, I'm all good. I could just use some warm weather. And she sent me the forecast, and you're going to be around highs of 60 on Friday and Saturday. So thank you, Michelle.
Yeah, and enjoy it while you're here, because on Tuesday, we are having ice and snow warnings.
On Tuesday, our high is supposed to be 15 degrees.
Yeah, we're going to be somewhere around that level here in Houston. So we're
good luck.
Yeah, it's going to be. In fact, our office is closed on Tuesday. There's just stay home because we don't want you driving in it, but. Yeah, it's supposed to be pretty bad on Tuesday. So, enjoy the brief snippet of warm weather that we're going to have for a few days. But it's going to be very nice while you're here. But speaking of the conference, kind of just some, kind of what your kind of broad level highlights. If somebody's coming to the conference, what can they expect to see talk about?
So I think the way I'm going to present it is as a DIY kit to not just understand. Last year I talked about what are bonds. Why do they move? How do they move? What can we expect under certain environments? This year, I'm going to take more of a DIY approach. So how do you look at bonds and say whether they're rich or cheap? What are those factors that drive bond yields? And the tough thing with bond yields versus stocks, we take a stock, Apple, IBM, name your stock. Its price to earnings can go to the moon. It can go to 200-300, which is a massive expensive premium. And it has very little effect on the economy. Now, if every stock trades at a high premium, kind of like a little bit of what we're seeing today, it does have some effect on the economy, right? But when bond yields fluctuate, you are having a massive impact on the economy almost instantaneously. So the feedback loop between interest rates and GDP and inflation and employment is huge. So bond yields beget bond yields. And the kind of the point of that is, as bond yields rise, you're weighing on the economy and you're negatively impacting economic growth, which then shows up in the data, which then pushes bond yields lower because the economy is growing slower and there's less inflationary pressures. And it's just a circular function. So what I'm going to, discuss is, review bonds, where they've been, why they're, and, spend a lot of time on the term premium, on the narratives that the quote unquote bond vigilantes are throwing out there. Are they true? Are they not true? What can you expect from the term premium? Can it further increase? Can it decline? If so, what does that mean for bond yields? if the economy slips a little, if inflation comes down to 2% or lower, what does that mean? So I'm going to give you the tools, give the attendees the tools that allow them to say, you know what, I don't care what Mike and Lance say. Here's what I think about these three things, and this is where I think bond yields should be. And that way, no one's going to rely on us anymore, Lance. They can do their own work.
They don't rely on us. They don't really listen to us anyway, so it's not that big of a deal. So
and we can just turn this into a sports talk show.
Exactly.
Be a lot more fun.
Yeah, well, in that case, we'll just get Adam's son come down and who is actually a sports talk host, and just have him do that with you. I'm sorry, Brent's son, Adam. Sorry, I did say that incorrectly, didn't I?
And our Texans and Commanders are both still in the playoffs.
Correct. That's so far. I am surprised. I am heartily surprised that we've made. I'm shocked, I tell you, that the Texans are still
preaching to the choir.
Exactly. So we'll see how this turns out. I don't expect them to make it much further, though. That's just I think our days are limited. Yeah. Yeah, I think Chiefs are going to pretty much clean our clock. So yeah. So all right, so that's good. So we'll kind of cover a lot of that real quick. Let's just talk about the term premium real quick since you brought it up, because it's something I touched on yesterday just a little bit. The term premium is very interesting because and again, it's interesting that people look at the bond market so differently than they look at the stock market. Stock market's going up. It's like, oh, hey, great. Stocks are going to go up. They're just going to go up forever. Valuations don't care. Economics don't care. The stocks are going up. Buy the stock. It's going up. And so I want to do this. And that's all sentiment, right? And so when we have a detachment of stock prices from valuations, we say, well, that's just market sentiment, and we have all these measures of consumer sentiment and stock sentiment and investor sentiment and all these type of things, and we can measure the gap between valuations and fundamentals versus the price of the stock through multiple valuation levels, etc., price to sales, price to earnings, all these type of things. So we have all these measures to measure the gap between where a stock is trading versus where it should be trading based on fundamental values. The bond market's the same way. There's a lot of sentiment that drives the market in the short term that detaches yields from the underlying fundamentals. And that's where term premium steps in. It's just simply a measure of the bond market sentiment relative to where, the fundamentals suggest that yields should be trading, because yields are very much tied to economic growth, inflation, and wages. And so it's interesting. It's just a plug number. You can't calculate the term. You can measure the term premium only by looking at the difference between yields, where they are, where they should be. But you can't calculate. You can't say, well, based in this environment, the term premium is going to be Y, right? It's not calculable. It's just measurable, and it's all sentiment. And I find it very interesting because there's so many people in the media that rely on term premium to explain why inflation is just going to keep going higher from here, but it's just simply sentiment is all it's measuring.
Right. And you could say, okay, the fundamental yield should be 3%, and we're at 4%, so the term premium is 1%. That's the easy part. Mm-hmm. And it's really easy to come up with that 1%. And there are a number of ways to do term premium, and they're all spitting out very similar figures. What you don't know, and what's hard with sentiment, is why is the bond market requiring an extra 1% yield? Is it deficits? Is it inflation? Is it the dollar? Is it liquidity? Is it 10 other factors that we're not bond vigilantes?
Yeah, exactly.
Which, can I just say 2 cents on Bond Vigilantes?
You have to wait till after the break. Yes. We'll come right back. We'll pick up with Bond Vigilantism, Michael Leibowitz, and wrap up the show. Don't go away.
investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. One of the interesting things is talking about bond vigilantes, and this is something that's, as long as I've been in the business, I remember back in the 80s, they were talking about the bond vigilantes are coming. It's almost like Paul Revere and the redcoats are coming. The redcoats are coming. Well, they actually that's not a good example because they actually came. But the bond vigilantes have been coming for decades. And, they never show up for one reason or the other. And there's really no such thing as a bond vigilante. The thesis is that at some point, the entire world is going to revolt against U.S. debt and no longer want to buy it. And it was interesting because to your point, I just read an article yesterday that 2025 is the end of the bond market for U.S. Treasuries. Nobody's going to want bonds after this year. So
that's good to know.
That's good to know. So, I mean,
we have some trades we better make today then.
Exactly. But I just find it interesting. But again, this is really the essence of bond market sentiment. It's really the essence of term premium and these short-term narratives that drive the bond market that have nothing to do with the long-term fundamentals. And again, it's very interesting because what fascinates me is that there's so many people focused. Look, you've been in this business almost as long as I have. Has there ever been a time that you remember more people being focused on yields and CPI and bonds? Bonds, most people don't even understand them, right? Because we never talk about them. But now all of a sudden, they're the topic of conversation, and everybody's an interest rate expert these days. I don't remember a time like this in previous history.
The only other one was 94, 95 with Orange County.
Oh, that's right. And the bond market crash in 94. Forgot about that.
Right. Yeah. So you said it perfectly when you kind of led off here. You said you used Paul Revere.
Right.
And what was Paul Revere? Vigilante, but he was a hero, right? So we associate vigilante with kind of a do-gooder or hero, that type of person. Mm-hmm. Bond vigilantes are traders that are shorting bonds to make a profit. Let's not mistake these people as they're not coming down to Washington and lobbying to cut the deficits or to get the Fed to to run a more prudent monetary policy. They're not vigilantes. They're people trying to make a profit off a narrative, off some sentiment. They're trying to push sentiment further. They're no different than people hopping on the NVIDIA bandwagon or MicroStrategy bandwagon, at a high valuation and just trying to push it higher. So that it's a term that kind of bothers me, because they're not doing that for the right reasons.
Right.
If you wanted to fight fiscal policy, that's not how you do it. So, again, these are people taking advantage of the sentiment, pushing narratives that are half-truths. The deficit is a problem, but you never hear them talk about GDP, right? The deficit, I just saw the number, the deficit rose $240 billion last year versus the year before. You know how much GDP rose over that same period?
You'll tell us.
We don't know yet, because we don't have the fourth quarter, but the prior 4 quarters, it was 1.2 trillion.
Right.
So there's no context. Inflation's going to rise, inflation's going to run. Well, how? Why? You don't hear that. You just hear stories being told, sentiment being pushed. They know they have the market in the right direction, and they're kind of putting the foot. They're pushing narratives that may be true, may not be true, but they're out for profit, not for the better of the nation.
Right.
So let's kind of, it shouldn't be bond vigilantes. It should be greedy Wall Street shorts, like they are in the stock market.
Yeah.
What do we call them in the stock market?
Short sellers.
No one has a good name for shorts.
Right.
Short traders.
Well, yeah, because again, and even in times of trouble, right? You remember back in 2008, we actually banned we banned short selling for a period of time, because they were hurting the markets. But again, look, I don't have any problem against people shorting, right? I just wanted to make sure that
it's a free market.
Absolutely. And I just want to make sure that our listeners understand there is a difference. In the short term, you have a lot of push on yields right now. And you just saw this yesterday was a great example. Over the last couple of weeks, we've had a very sharp increase in yields because it was a directional trade, and Wall Street was just piling in with more shorts and more shorts and more shorts, which were pressing bond prices up bond prices down and yields up. And you saw that yesterday is like when that number came out, all of a sudden we've had the sharpest drop in yield since like 1993 yesterday, and that was all short covering. And that was just all of a sudden, all the people were on the wrong side of the trade. And they're like, oh, that's not, I thought inflation was going to come in hotter and I was going to make a bunch of money. I've got to cover that position now. And so you saw this big reversal. But that's why you have to separate out these very short-term moves in bonds versus a long-term reality of what fundamentals will do economically to economic supply, demand, jobs, housing, all those things that are interest rate sensitive.
And this is where what I talked about earlier is so important to understand these narratives. MicroStrategy could run for another 5 years because it has no feedback effect on anything. It's just a question of whether the bulls can maintain sentiment and keep sucking in more bulls and getting sellers to not want to sell because the trend's going up, right? Just creating more demand than supply, right? It's that simple. But there's no feedback loop. If MicroStrategy becomes the largest market cap stock in America, so what, right? A few people will be wealthier, but the marginal effect on the economy will be nil. Whereas, again, yields have such a huge effect. I mean, look at the mortgage market. The mortgage purchase index is at the lowest level it's been in 20, 30 years, if not lower. And the population is much higher today than then, right? Car loans are ridiculous. Corporate borrowing, corporations have a big problem now because they took out a lot of debt in 2020, 2021 that's starting to mature this year. So all of a sudden they have to refund debt, that 2-3% debt at 5 to 7, 8%. That's going to hit their bottom lines, and that's going to force them to fire employees, to cut back on spending plans, to, whatever else it is that's going to reduce their spending. So the feedback loop is pretty immediate with bond yields versus stocks, and that's something that if you're riding the vigilante sentiment trade, you better hope they're right, that deficits are a huge problem and that inflation is going to spike again.
Right. So, and again, one thing that people, again, to your point, is when a company is looking at a capital expenditure, if I'm going to go out and build a new property, plant, I'm going to buy some more equipment, I've got to borrow money for that, and I'm looking at, okay, I've got to borrow money at, 7 or 8%. And if my expected rate of return on this investment is only 5%, I'm not going to do it, right? Because I can't make a profit between that. Or, I borrow at 8 and my expected return is 9. There's just not enough profit margin in there to make it worth borrowing the capital for. And again, this really applies more to small and mid-cap companies. And this is one thing that I've been asking this question as of late. And it was interesting because we just saw the sharpest reduction in estimates for small and mid-cap companies that we've seen in like 20 years. It just happened over the last couple of weeks, just a very sharp decline in estimates. But Wall Street's been expecting this huge resurgence in earnings for these small and mid-cap companies, which are extremely tied to economic growth and, more importantly, higher interest rates. They don't have the ability to, they're not like an Apple that's got $150 billion sitting in cash money markets right now that they can go, fund a project with or buy a company with, and they've got zero cost of capital. But for these small and mid-sized companies, the cost of capital is very important to their profitability and their ability to expand their businesses going forward. So we're about to see the impact of those higher yields on refinancing of debt, et cetera, over the next couple of years in particular.
Right. Why did JPMorgan just hit it out of the park? Because they can raise those rates much more, they can make a lot of money on those loans versus what they can do in the bond market, in the corporate bond market. And the corporate bond market is where Apple and Meta and all the big boys, the S&P 500 companies, are borrowing. And that borrowing is relatively cheap compared to treasuries. But loans are not so cheap. And that's where banks can try to make up some of this profit margin. And, to the degree that they are paying out higher deposit rates, make it up on the other end, because they have to make it up. They're there to make a profit. They're not going to lend money for a loss. So it's going to have a big effect, especially on mom and pop businesses. And then, kind of that next range of 50 employees or more, that small cap, and even some mid caps that just can't borrow from Wall Street, that have to go to banks or to other lenders. That's where we're really going to see the effect. And, my guess is it'll take a couple months to see it in data. It just takes time for, even if I decide not to buy a car today, you're not really going to see that till March, April in the economic data. So that's when we should be on the lookout for weakening data. It's kind of February at the earliest, March, April, May is when it should really hit.
Yeah, and we've got to get past all these, we've had 2 major hurricanes that created flooding, that created, people had to go buy new couches and new cars and new tables and new microwaves and everything else. So there's been a lot of demand in the durable goods space. We'll see that from these California fires as well. But once we kind of get through these anomalous effects, we're pulling forward a lot of consumption that's going to leave a void in the future as well. So we may get a short-term, bump to economic activity from all these disasters, which are a terrible thing, but, longer term, it creates a pull-forward situation on consumption that's going to impact economic growth. All right, that wraps up the show for the day. If you haven't got your tickets for this weekend's conference, please do so. Get by the website, realinvestmentadvice.com. Click on the blue banner. Get your tickets today. We'd love to see you there. And Monday is a holiday, so we'll be back on Tuesday with our next show. But don't worry, Richard Russ will be here tomorrow for Financial Fitness Friday. I'll see you back here on Tuesday.